Welcome to the 3 Edge Week in Review for the week of January 29th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing this past week's meeting of the Federal Reserve's Federal Open Market Committee, where, as anticipated, the Fed chose not to begin to reduce short-term interest rates. And so, since the Fed took no policy action, the folks on Wall Street were once again laser focused on Fed Chair Powell's press conference at the conclusion of the meeting to see if he would provide any clues as to when the Fed may begin to cut short-term interest rates, which are currently at the highest level in more than 2 decades. And in his remarks, Powell continued to push back against the narrative on Wall Street that the Fed could begin to lower interest rates as soon as March. Powell stated that more evidence was needed that inflation has been tamed before considering interest rate cuts. The news on inflation front continues to be positive. The most recent report on the Fed's preferred inflation measure, core PCE, which excludes food and energy, has now fallen below 3%, which is the lowest, I believe, in well over a year. So, Steve, let's get started and let's try to dig into this gap between what Wall Street is expecting or maybe hoping versus what the Fed is and Chair Powell are saying. Will those come together at some point? And what's causing this disagreement or this gap?
Well, Fritz, basically, Wall Street really wants the Fed to start cutting rates well in advance of any economic problems to keep this rally going. And the justification by Wall Street is that we have a narrative of immaculate disinflation, meaning that inflation can come down by itself without the economy slowing down. And so far, inflation has been coming down. And if Wall Street extrapolates the recent trend, they get back to the target 2% inflation rate pretty quickly. So they want to see the Fed cut rates as soon as possible. Now, I have to say the Fed has a very difficult job in general. And that history shows that most of the time, the Fed waits too long before they cut rates. Usually the economy seems to be going very, very well. And they say, well, why do we need to cut rates? And then once they see something break, like an economic slowdown or a market correction or debt crisis, then they act. And of course, that's too late. And then we go into a recession. Sometimes the Fed cuts too early. They declare victory on inflation too early, like in the 1970s. And that looks good for a while. And then we have another inflation cycle that's even worse than the first one. So we have a strong economy right now that's evidenced by the recent strong GDP report, by the recent strong employment report. And that's giving Powell the cover to say, look, we're not going to cut rates in March. We're not going to cut rates for a while. And he can hold them higher for longer with the hopes that he can declare victory later on a more sustainable way on inflation. But of course, the problem is, he says, well, he's looking at the data. And of course, the data is backward looking because it's reporting what happened in the past. And by the time the data shows up any problems, it's going to be too late.
All right. So I know it's not fair to ask to predict the future, but how might this play out then in the end? So what could change the Fed's mind, for example, and make them go sooner? How do you sort of game that out if you're trying to anticipate what could happen this year?
Well, right now, the market's doing extremely well. The U.S. economy is doing better than all the expectations. And that's going to make the Fed feel justified that they can hold rates higher for longer and continue to fight one of their mandates, which is to control inflation and bring it back down. And so with these recent reports, it's likely to embolden them to do that. The one fly in the ointment is that right now, the short-term rates continue to be higher than the long-term interest rates. Right. And any time in history that they've been higher than the long-term interest rates by this degree for this many months in a row, in 150 years of U.S. history, we've never been able to avoid a recession. There's always eventually hit a recession. Usually people say, oh, look, we have no recession. The inverted yield curve doesn't matter anymore, but that's because they don't wait long enough and eventually you get a recession. I think all the fiscal stimulus we've had has helped prolong that point, but it doesn't mean that there's absolutely no chance of a recession. History says that there is a chance, and we think Wall Street's being too complacent.
Yeah, and we did have that little hiccup yesterday, or not yesterday, a couple of days ago, where we had some, quivering in the regional bank market, right? And so probably that could be one of the, an event like that could certainly force their hand maybe. So my final question, as always, is based on what we've discussed here today about the gap between what Wall Street is hoping for and what the Fed seems to be planning as we go through the year, how should investors think about their portfolios now looking ahead in 2024?
Well, I want to begin by saying these are not normal times. This is not a normal environment. I'd have to say in the current environment, the gap between the upside scenario and the downside scenario is about as wide as it could ever be. Let me explain. There is an upside scenario, and it's pretty rare in history, but it has happened from time to time. And I'll describe it as a market meltdown. Sometimes it's called a blow off top. Sometimes it's just called the last hurrah. And it's typically the end of a long bull market. Doesn't always end in a whimper. Sometimes it ends in a bang. In other words, the market just rises exponentially right at the end. You get your sharpest gains right at the end. And it's very much driven by crowd psychology that might have seen some great earnings reports, might have seen better than expected economic reports in the short term, and it continues to get excited. And when the market goes up like that, it feeds on its own momentum, and people who are on the sidelines just can't stand the pain of missing the market and just throw more money at it. And this has happened throughout history. It happened in the 1720 South Sea bubble. It happened in 1929. It happened in early 2000 in the tech stock bubble. And it's certainly possible that this is happening again and that this could still have a ways to go. So the upside could be a sharp rally that still has legs. The downside, on the other hand, is not so pretty. And of course, every market melt up, sometimes it lasts longer than people expect, but it always is followed by a big hangover in a sharp decline. Now, on the negative scenario, it could be that with all the monetary tightening and all the lag and all the delay because of the fiscal stimulus, that eventually the monetary tightening really starts to hit. And you mentioned, problems maybe in commercial real estate or regional banking and ripple effects across the economy from that. It could be problems internationally where there's some international markets that are teetering on recession that could bring down the global economy. Could be a black swan that's hard to predict. It could be a geopolitical event. But if we do start to get a bear market, people then ask, well, how far can this bear market correct? And one of the answers is that often a bear market might correct until you get back to fair value. And our measure of fair value, we try to do a very comprehensive look on this, is a long way down from here. So on one hand, you've got an upside scenario where we could have, a real exponential market melt up. And on the other side, we could have a correction that turns into a really strong bear market. So how do you allocate an environment like that? Well, we wouldn't say, well, first of all, we'd say a lot depends on your risk tolerance. Is your priority higher to avoid any possible loss, or would you feel more pain by missing out on a rally? And everyone's different. And some people have different pockets of money where one pocket of money might be in a more conservative portfolio. The other pocket of money might be able to take on more risk. And we have strategies that accommodate these different risk portfolios. We have conservative, a moderate, we call total return. We have an aggressive, more aggressive, we call growth. And then we even have some equity-only strategies that are even more aggressive. So we can accommodate a lot of that. So the first question is, good time to do a real gut check on your risk tolerance. Second is within each of those buckets, whether it's a conservative bucket, a moderate bucket, a more aggressive bucket, look at what I like to call targeted diversification, not just diversification for the sake of being diversified, but targeted diversification, looking at the most likely scenarios and making sure you have something in your portfolio that's working for you in each of those likely scenarios.
Right.
So for instance, the market melt up, there is some possibility that happens. So we say, have some equities that can benefit from that market melt up. But don't put all your eggs in the one basket, because it could be great on the way up and not so great on the way down. Next, what follows a market melt up, or what follows a bull market, is a credit contraction. And that's when the monetary tightness finally takes hold in the economy and in the markets. In a credit contraction, you want to own short-term, short duration treasuries. And those could not only make money while you're waiting, but could be a nice reserve to take advantage of bargains after the next downturn. And then finally, there's no shortage of geopolitical worries in the world. There's the possibility of something bad happening in the economy, and the Fed comes in with new stimulus. There's the possibility of stagflation, where inflation doesn't continue to come down, but it gets sticky with wages still high and starts to go up again. Or if oil prices go up, that could bring the inflation rate back up. At the same time, the economy could slow down. You have stagflation. So in a case where you have geopolitical conflicts worsening, possibly new monetary stimulus, possibly stagflation, then assets like gold and TIPS, Treasury Inflation Protected Securities, we think should do much better in those environments than typical stocks and bonds. So we think it's important to have representation in those areas. And then finally, I would say that since there's such an extreme gap between the most favorable scenario and the most favorable scenario and the most down scenario, we think that it's really important not to have a buy and hold strategy and relax and be complacent, but to be on guard and to constantly be watching the key behavioral and macroeconomic factors that could really flip a strong market melt-up scenario into a correction. And that's something we do every day.
Excellent. Thank you for that. Thank you for your insight. It's a very comprehensive way of looking at the situation where we're in here today, and it is a situation that is highly uncertain. And so very much liked your response there. I would say my takeaway from our discussion, or what we've seen, this difference between what the folks on Wall Street, when it comes to the Fed's decision making, what they are expecting, or probably more accurately, what they're hoping for. I'm reminded of a Glenn Miller song where he says that wishing makes it so, but unfortunately in the real world, that is not the case. So anyway, that will do it for Steve and me for this week. But let's finish out with the song by Glenn Miller to take us home. Thanks for listening.
Wishing will make it so. Just keep on wishing, and cares will go.